Hey guys, welcome back to Merry Men Trading. My name is Ben. I am with,
My name is Zach.
this is Zach. Zach is my brother-in-law, and he is um, the man. So anyway,
Sure.
we're talking options today, and so I've had Zach join me today as we talk through some of this stuff, and it's kind of going to be a little bit of an options explainer video. Zach's going to ask some questions. I'm going to try to answer as best as I can. And for those of you watching on YouTube, make sure you like this video, subscribe to our channel. And if you have questions about options or anything else, you can ask it in the chat on the comment section underneath the video. If you go to our Facebook group, Merry Men Trading, you can ask questions as well in there on not just options, but really just about anything as far as investing in the stock market is concerned. So let's get into some things. I'm going to share my screen. We're going to get started. So really, a really basic explainer of what options are is options are contracts. Options are contracts on 100 shares of the stock. So as opposed to necessarily buying or selling the stock, what we're going to do is buy and sell a contract. And what the reason anyone would do this is not so they can actually, or usually not so they can buy a contract and then buy the shares, but often you're able to use the same amount of money you would invest on the stock in options, but you get a much larger turnout for your investment. And so to kind of explain this, we're going to kind of fool around with Tesla a little bit. Today is February 2nd, 2021, Groundhog Day, ladies and gentlemen. So I know this is a big trading day for so many of us. And currently Tesla's stock is at $878.46. So we're going to go over here and just kind of play around with this. So if we said that Tesla is at 878.48, if we were going to invest in this and buy 100 shares, that's going to cost us $87,848. Zach, do your math. Is that right?
Yeah, 87,000.
Okay, that's a lot of money. And I don't know about you, but I don't. Zach, you may have this money in your account. I don't have $87,848 in my account. And so, a really simple way to get involved in trading something like Tesla, a cheaper way to get a better or the same turnout, is instead to trade options. And so, there's a real simple strategy into trading this. These are all these blue Tesla contracts are in the money, and meaning that they are less than the $878 a share price that we have right now. Everything in the white is outside of the money. What you're going to see is the farther inside the money you get, the more expensive the option trades cost. It's $585 a share if your strike price is at $200, because the odds of it going below $200 are extremely low. So what we would typically do is instead trade outside of the money options contracts. We're going to get into that strategy and stuff here in a little while. Let's not get ahead of ourselves. So anyway, so what we're going to do, just for the hay of it, is we're going to say, so we need $87,848 to buy 100 shares of Tesla stock. But if we just look at the option contracts themselves, we're going to go right here at the $880 strike price. We could buy this option at $18.35 a share. Sorry, my Canadian punctuation's acting up on me. So then we multiply that times 100 because the contract is for 100 shares of the stock. And what you're looking at is, instead of paying $87,848 for this trade, you're paying $1,835 for this contract. And so this is a real simple way that a lot of people get in to more expensive stocks and are able to make the profit that you would if, say, you owned 100 shares of the stock. Zach, does that make sense?
That makes sense to me. Yeah. So you just have to, when you're looking at, if you go back to your Yahoo Finance, you have to look at the price of the share, and that's just automatically, when you put in a trade for it, it's automatically going to multiply by 100.
Exactly. And so Tesla's a good example, but there's tons of other companies out there that you can buy and trade options on. One of the ones that I'm really enjoying right now is Century Communities. They're a residential house developing company, and I love buying their options. They're a solid company as far as their financials are concerned. And so here, say you wanted to buy a $50 call option. A call option is essentially, well, let me explain that here in a minute. But a $50 option in this is $2.15 a share times 100. That'd be $215. So it's a simple way of getting in on an investment without having to pay that full price. So there's a couple ways you can trade options. There are call options and there are put options. And a call option basically is an option where you think the price is going to go up, and so you buy into the call option for most circumstances. Meanwhile, a put option is, instead of buying in, you sell the option. So you're selling a contract of 100 shares, and instead of paying for something, they actually pay you money to sell this contract. Even if you don't own the stock outright, you can still sell a put option. And if it goes down in price, then you can buy it back later and make money off of the option contract. And with a call option, what you usually want to do is buy it in the beginning and sell to close, just like you would a stock. So what we're looking at right here with Century Communities, for instance, are some calls here we see for February 19th, 2021, or puts February 19th, 2021. If we wanted to buy a call at $50 a share for the strike price, what we're saying is we think that it's going to get up to be $50 or above by February 19th. It would cost us $2.30 a share, or $230 to get in. But if we thought it was going to be less than $50 a share by February 19th, we would sell a put option, and we could sell it at $290, $330. And they give us that money at the beginning, and then we buy back later when the option is worth less money.
I think an important distinction too is some brokerages will use the term like debit and credit as opposed to like negative or positive. So like for put options, you might see that you have like a negative credit or something like that, but that's actually saying that they're going to deposit that money into your account until that option is expired or you decide to buy it.
Yeah.
So and then debit, of course, is on the opposite. Yeah, for like a call option, a debit is just your money is actually leaving your account.
Mm-hmm. Yeah. Thanks for clarifying. That's a really good point. And so this is genuinely, I think, one of the funnest strategies I find in investing. And there's a couple of reasons why I really enjoy this. One, it costs less money than often buying the stock outright, but you get often the same return, if not a larger return. And I think that's the beauty of option trading, is you can make a lot of money off of a little bit of investment. And so this is something that Zach and I have been working through. We've been working on some of our strategies, and I'll just kind of show you a few examples along the way. So got a couple option contracts in here in my account. Here's a Lightspeed one here for March 19th. The strike price is at $150 a share. I paid originally $1.40 a share, or $140 total for that contract. Since then, currently the option contract's kind of evaluated at $170, so it's made about $30 on that investment. We'll go over to Yahoo, and currently the price of the stock is $71.57. So it's gone up since my initial investment in the company, and that's where it's at now. And again, like, as opposed to paying $71.57, as opposed to paying $7,157 in that stock, I paid $140 to get in on that investment. So there's a lot of different strategies you can employ with options trading, but this is one of my favorites, and I think there's a lot of opportunity to be made in options in this market. I think it's really important to understand that the market that you're trading in is good and conducive for options trading, or even bad, and maybe then it's actually a good strategy to sell put options or whatever else. Zach, do you have anything you want to add to that?
I know one of the questions that I was really, or one of the things I was really confused about to begin with, if you go back to that Lightspeed, and then we can also switch over to E-Trade in just a second. So it's clearly at, so do you remember what you bought Lightspeed at? Like what the market value was when you bought it?
I don't.
Okay, well, it was clearly below $71 or whatever. One of the things that I thought to begin with, which was incorrect in my assumption, was that in order to make profit, you have to reach that call price, which was clearly based on your financials and what everything looks like. You're in the green even well before. I mean, you're $50 off of that call price. However, you're still making profit. Can you explain at what point in time does that 115 call price actually like come into play? Explain that for us if you could.
Yeah, that's a good question. So there's a couple of things that he mentioned there that are really important to understand in options trading. So again, this contract is priced at 115. Yes. If you haven't heard the news, NCAA football by EA Sports is coming back. Anyway, it's a beautiful day in the neighborhood. So his question is about, like, when does the strike price come into play? So there's a couple of things you need to be aware of when it comes to options trading, and those are what we would call the Greeks. Let's see if I can figure out where to pull that up. Just go over here to options, and these kind of tell us a little bit of of what Zach is referring to there. What was that, a March call? Is that right?
Yeah, I think it was March 19th.
Yeah. Okay. So if we go to, I'm going to do it, this is on E-Trade, different systems do things in different ways. But basically, as you go into something like an option, the Greek formulas are really important measurements to understand. So especially the delta and the theta. The theta is basically the time decay. So as this contract gets closer to its expiration date, it's going to be worth less the more outside of the money it is. And with an option, what you'll often see is like an options like analyzer, and you'll have your strike price in the middle. And if you reach the strike price by a certain day, this is what the option will be worth. If it's past that by the date set, it'll be worth this much. If it's below it, then what happens is basically you essentially begin losing money. So at this case, let's say it's $115 a share for the strike price on March 19th. Getting in is somewhere around between, it says the last price paid was $1.40 or $140 a share. Now the theta decay is what you're going to look at here, because right now the theta decay is at 0.69 or 7 cents a share. And that is basically saying per day, this is what this contract loses in value. Because the more it is outside of the price, the more value less it's going to be on that day. And so every day we're basically losing essentially 7 cents times 100, $7. And so what we're trying to do is see this option basically grow in value as it gets closer to the strike price and offset the time decay that we're having in the theta valuation of it. And so this is a really good way to measure it. So obviously, like if you get up here at the $35 strike price, the time decay is 8 cents a share. Of course, you're also look at the bid on it. You may be losing some money on time decay, but you're well above the strike price for this contract, $35, because it's $71.
And if you were to go to the February, I bet the theta would probably be, you'd be losing much more every day. Yeah, there you go. So that's an example there too.
Yeah. So yeah, that's a really good thing to understand with contracts. So like with a contract, you're going to lose value the more time takes place and the farther you are outside the money. But the beauty is that because often one of our strategies that we like to employ is we like to buy contracts way outside of the money. And so what we'll do is we'll buy a contract outside the money with a very low delta, a delta in the 10s, the 20 range. And what that allows us to do is as the strike price, as the option price, as the stock price gets closer to the strike price of the option, the delta increases or multiplies as it gets closer to that. So we may start in the 10s or 20s, but by the end, it's getting closer to the 80s or 90s. And what happens along the way is that the price of that contract multiplies. And so this is a really good way to buy an option and get in at a very low price, sometimes $40, $45 a contract, but then you can double it very, very quickly. And so it's a risk because you could full well lose all of that money just as easily as you could gain it. However, by and large, if you give it time in the market that we're in right now, this is a really good strategy to use to buy options. Any other questions you think would be good to cover there, Zach?
So essentially, just to summarize what the strike price means, that if you were to be around, I guess, in that option for Lightspeed that we were just talking, if you were to be around 150, if the market price reached $115, you would expire with actually zero profit if you let it to go all the way to expiration. Is that correct?
Say that again.
When you buy out of the money, high up, it's cheaper. However, you're running the risk of never making it there. So you're going to lose all of the everything you put into it, right. $140 or whatever your example was. If expiration happens and you are anywhere below 115, it doesn't matter, right? You're still going to lose the same amount because your theta has already decayed all the way off. You don't have any kind of value like that. Everything is just essentially stock value at that point in time. However, if you were to, I guess my question is, our goal is to not necessarily hold these options until expiration. Is that correct?
Yeah, that's very true. As a matter of fact,
because that was another one of my questions when I first got into this was, is our goal to hold it to expiration? Is that like the thing that you want to do, or do you want to, sell it well before expiration if you're already making a good profit on it?
Yeah, and it really all depends on your strategy. So for some people, they are going to hold to the end to see how much they can make off of it if they're making good profit. Other people, anything can happen in the stock market overnight. That's something that we've seen over and over again with the whole COVID pandemic. And so, so some people like to take their chips and run when they can. I like to cash out as early as possible when there's a good return. So there's a couple, I think, rules of thumb I think that you can also think of along the way. Like Zach talked about, the strike price is the agreed price upon the contract. So if you buy a contract and it never reaches that strike price, it will gain value. But basically what that is saying, I am agreeing to buy 100 shares of stock at this price on this date. And so if you hold that option to the bitter end, and you let that contract, run its full course and expire, if you buy a contract, then no matter what happens and you hold it to expiration, or through expiration, at that point, the company's going to come saying like, okay, you have to pay $115 for 100 shares, $115 a share for 100 shares. If you don't have that money, then that's going to put you in a bind. So you always want to sell one way or the other on how you, regardless of how you perform. Otherwise, you're going to end up finding yourselves in a lot of debt, especially, let's say Lightspeed's still at $75 a share. I just paid I'd have to pay $115 a share for a contract or for a stock that's $75 a share. Well, I'm losing $40 a share in value. So it's not really worth keeping. So usually you'll want to cash out and sell. So there's a couple of different strategies you can have, and we'll talk about strategies along the way, but we kind of want to make sure we're kind of covering the basics at the time. Anything else you think would be good to talk through?
No, that's pretty good for now. Yeah.
Okay. Well, then let's talk through a few strategies, some things that kind of like you and I've already kind of talked through and worked through, and we're kind of doing right now. There's a lot of different strategies out there. So if there's another strategy you like, maybe you're watching the video, feel free to comment and put it in the chat below. Or if there's a strategy out there you'd like us to kind of cover, we'd be happy to talk about that. I want to share with you kind of two strategies today that I use that I think are extremely simple for anyone to use, and are a really good way to generate income, especially in the market that we're in right now. So the first one is just a simple long call strategy on a far out of the money option. And so this is something Zach and I have both been doing. I'll share my screen with you and try to explain what I'm talking about. So we'll go to this account. Don't judge me the fact that I've lost $10 today. Here we go. PAGS. I bought this a few days ago, and I paid $1.59 a share, or $159 total, for an option dated August 20th. So we got a long way till then, with an $80 strike price. So let's put that up here, kind of work our way through it. Maybe as I explain to you what I did, you'll begin to understand a little bit how we've profited off of this thus far. So August 20th, 2021. $80 strike price. Cost us $1.59 a share for $159. So, I talk about TradingView a lot. TradingView is a really good website as far as looking at stocks, charting stocks. If you're trying to figure out whether the stock you think is going on an uptrend, which I definitely think PAGS has a lot of potential for the future. This is not investment advice. Do your own research. Talk to an advisor or something like that. But anyway, I bought this contract on yesterday when the market opened. It started here, went down, but today it's going up really quick. It's gone up basically $3 a share. And so what I did is I bought this at a really far out of the money price. I mean, the price is at $80 a share. However, I have nearly 7 or 8 months for it to reach that price. And so at such a far out of the money price, I paid a small amount of money for it. Matter of fact, what we'll do is just kind of pull up the option here so we can kind of see the deltas and all of those valuators. Greeks, August. I'll kind of show you some things that I looked for when I bought this. So here's where it's at right now. It's between 215 and 240 at that contract. So again, I paid $159 and right now it's at $215 a share bare minimum. But the delta was in the teens when I bought it. Right now it's at 223, so it's already gone up in the delta. And the theta, the time decay, is less than 2 cents a share, or $2 a day basically, time decay. So that's a really good number to know and understand, because you don't want to be losing a lot of money every single day. That's not a good sign. And so I found something with a good theta decay, and I got in because it had a very low delta. So basically what happens is as it gets closer and it gets into the 90s, this price is going to begin multiplying as it gets closer and closer to, as the stock price gets closer and closer to that original strike price. And so what we're trying to get to is see this delta get to somewhere in the 90s. And the reason being is because the delta at that point is basically every dollar of movement by the stock. At that point, we're making about $1.10 in the option. So right now, if we subtracted 100 from 223, you're going to get 78. So basically, every dollar of movement in the stock should bring in about $1.78 on the option price per share. And so there's a lot of potential here, because again, that's basically $178 every dollar of movement in the option contract for 100 shares. And so there's a strong possibility here of movement. But as it gets closer, that delta gets smaller and smaller to the dollar amount. And so at the 90 point, it's basically probably worth getting out, because at that point where it's just basically 1 for 1, and there's not a lot of value in buying or selling the option as opposed to buying and selling the stock. But buying a far out of the money strike price option is a really simple strategy. It's a really affordable strategy. If it never reaches $80 a share by August, then the most I could be out of is $159 that I originally paid. Whereas if I bought 100 shares of the stock and it drops $1.59 in the stock price, I'm at $159. So it's a really simple way of getting involved in the movement of the stock that you think is going to go up, and it's a really cheap option. Zach, you have any experience or anything you want to share with the viewers?
I just have one question as to why you choose August as opposed to choosing, the next month, March or May?
So it's all about the delta and the theta. So there's two things I'm looking for here on a long call. Is it's far out of the money, decent date, meaning that like it's not 2 weeks from tomorrow, because the odds of it reaching going from where are we at right now, $54 to $80 in 2 weeks is very, very
Yeah. And then your theta is so high, you're losing tens of dollars every day or more at that point in time. Okay.
Yeah. Okay. So I look for the delta let's see, less than 20, and a theta of less than minus 0.02. And so I just chose an option that fit those two parameters.
Yeah. If you are going to save the spreadsheet, you're going to want to change those carets around, because right now you have delta greater than 20 and theta greater than 0.02.
Nuh-uh.
Just, yeah. The alligator eats the bigger number, so you want the alligator to eat 20 because you want it to be less than 20.
Are you sure?
Oh yeah, 100%.
Oh yeah, no, you're right. Thank you. Okay. Delta less than 20 and a theta less than 2.
Just in case somebody reads this without subtitles or something like that.
Sure.
Okay. Yeah, no, I don't think I have. Oh, and just to clarify, just for anybody that that might not know the analogy, just a long call is just buying just a call option.
Yeah.
Hoping that it goes up.
Yeah.
Long means that you're buying, short means that you're
selling. Yeah.
Doing some hedge fund stuff.
Yeah, so there's a lot of different strategies. I mean, there's people out there who will do a horizontal trade where they'll buy an option for $50 and then sell an option for $50. And so, and you'll often make a little bit of difference in those, but you don't often lose a lot or make a lot. Whereas this strategy, this is just a straight up gamble where we're like, you know what? I feel good about this. I think there's a lot of potential for this stock to go up. And so I'm going to sink some money into it and see what I can get out. And so I would say don't use your whole portfolio or even most of your portfolio to trade this strategy, but you can use some of your portfolio to make this strategy. And if you are successful in this strategy, and Zach and I have had several wins along the way already, then one good trade could offset a couple losses. And so I find it a really simple strategy. Again, in this market, it's a really good strategy to employ. Right, Zach?
Yeah, absolutely.
Yeah. So another strategy that I really like, and this is a safer strategy. It's a strategy I use for a lot of my accounts, is what I call a poor man's covered call. You may also hear this as a calendar spread or a diagonal spread. There's a lot of different terms out there for it. But basically what we do is we buy a call option and we sell a call option. Let's say buy a call option with a far expiration date. And then we sell a call option with a near expiration date against it. This is a really cool way to generate income and make a lot of money with a little bit of money, if that makes sense. My parents, I taught my parents this strategy, and they had like $3,000 in an account a few months ago, and now they have $5,500 just by using this strategy. It's a real simple strategy, and I'll kind of show you a few ways that I've traded this along the way. So, have I shared my screen yet?
No.
Oh, let me share my screen.
We've just been looking at your beautiful mug for the past couple seconds here.
Nice. All right, so we're going to share the screen. So what you'll see, I have a few of these. ASO is one where I've used this strategy CCS, I think, is a good example. So we're going to play with CCS a little bit, and I'll try to explain to you how a diagonal spread, poor man's covered call, whatever you want to call it, works. So what I did is I bought a long call option in CCS. Notice the expiration date is June 18th of this year at a $35 strike price for the stock. Just for reference, CCS is currently trading at $49.24. So this is inside the money. It's pretty far inside the money. And I think there's a couple criteria that I would use to look for in buying an inside the money call option. But you're going to look at something far inside the money. I would say at least 10% inside of the current money. So at least if it's $49, something that's at least, I would say, less than $44. $44 or less is what I'd be looking at. So let me actually add that. At least 10% less than the current stock price. And I would look for something with a delta in the, oh, here's the alligator. Here's the alligator in the 90s.
There you go. Yep.
Boom. So look for something with a delta in the 90 range, because in this case, we do want it to almost trade virtually with the dollar. And then what we're going to do is we sell a call with a near expiration. That's exactly what I did. So notice it's February 2nd today, and this contract is a sell contract for $55 a share. So basically $6 more than what we're at currently. So I paid $1,561 for, we're just gonna kind of scratch this together. So CCS, we buy for, what did we say, $1,561?
Mm-hmm.
That's what we paid for this call option, this long call, and then we sold a call option against it. Now you would never sell a call option in any other category unless you're trading it against a buy of some sort. But so we sold one here, and what they did, excuse me, here we are, is they paid me $119 immediately for selling that. So basically, it's a way of getting some money back off of this investment. So then, even though it says I paid $1,561, what I actually paid was $1,442, because basically they are giving me cash back. Now here's where I think this strategy is really cool and beneficial. If February 19th comes and CCS is trading for less than $55 a share, which it's never traded at that price. It would be an all-time high if it traded at that point. If it's trading at less than that, then basically the CCS contract that I've sold here will expire worthless. And what we've seen, sure enough, due to theta decay or time decay, is it started at $1.19 or $119, and now it's at $90 total, or 90 cents a share. So we've seen some time decay, and so if it expires less than $55, $54.99 or less, then basically I just made $119 selling against this one. So then what I can do going into March or mid-February is I would just sell another contract against this contract. And so what I'm doing is basically milking this contract along the way. And again, I've made a decent amount of money already, because this one's priced at $1,561, and right now it's at $1,605. A lot of that has to do with the implied volatility going on with option contracts, and that's a whole other discussion. But anyway, so it's a good way to generate money off of an option along the way. So even if it goes down in price, I'm still bringing some money in as just kind of some leverage along the way. And so I could do this all the way going into June if I wanted to. Now, again, this is going to continue to lose money due to time decay. However, I can offset my losses by selling an option against it. And what this can do for you in the long run is it's a really simple way of say, instead of buying 100 shares in this stock and trying to earn all of that off of it, is I can pay basically, and instead of paying say $4,935 for 100 shares, I can pay $1,605 and get the same price action that I would 100 shares of stock, if not more so, due to the growth. Zach, anything else you want to add to?
I got maybe a question or two. At what point in time do you buy to exit that close in the future call?
So there's a few different times that you would do that. One, I like to do it if it's really obvious that it's not going to reach that strike price of $55 going into the last week. It'll be down in like the 10s or maybe the 20s. And there's at that point, often I will roll it out just to make sure that like inside traders or hedge funds don't jump in the day of and try to drive it over that strike price and then make me lose out on all that money. So I will roll it at that point where I basically pay $10 or $20, but then sell another one for $120 out, if that makes sense. So that's a time that I would buy. Another time that I would buy is if it's obvious that it is going to be outside of the money. And so often what you'll see is if it goes up like 50% in value, 25% or 50% off of what they originally paid me, I will often sell both options at that point. Because what happens as that price goes up, and we could look at this if we wanted to, for sake of time, we're not going to it right now, but each of these have a delta. And the delta, we basically subtract the deltas from each other. So let's say that this delta is in the 90s and this is in the 40s, let's pretend. Then there's basically a 50-cent difference, right? And so every dollar of price action, we make about $1.50, if that makes sense. But as the sell call gets larger because it's farther inside the money now, what happens is that delta margin gets smaller. And so we're not making as much at that point. And so what I like to do is, let's say it's $1.19. If it were to go to $1.79, at that point it's gone up about 50 cents in value, I would sell. And the reason being is because the call option that we bought originally, it's gone up as well. And so we've still made money on this trade. It's actually, that's what you want to see happen. However, at that point, the delta spread is getting thinner and thinner. And so we're not making as much off of it at that point. And so then I would sell again as well.
Okay. So you, in a perfect circumstance, where do you want the market price to be? Do you want it to always stay in between your sell option and your buy option? Or do you want it to go above your 55 call?
I'd say you want it to go above the call, because that's how you're going to make the most money. Now, what you don't want is to see what happened with GameStop, where this happened to me, where I was in on GameStop early before this thing started, and it started picking up so much speed that I started losing money due to the implied volatility of the nearer options. And so the delta spread basically just got smashed as the price skyrocketed, and all that you had was the implied volatility in this month was much higher than the implied volatility of farther out months. And so I was losing value at that point. And so I got out, and I'm glad I did, because otherwise I would have lost about $1,000 on that.
Gotcha. So if the market price goes above your sell option, which you've already received a credit on, we already mentioned that you got, let's just say if you paid for it right now, you would get $119 back.
Yeah.
If it goes above that, do you ever owe money on that sell option, or is that where you lose your money at?
Yeah. So
Okay.
you can lose money again, like if you stay in, like with the GameStop example, just due to implied volatility, implied all this different stuff. You can lose money at a certain point. Yeah. And so you've got to be careful. Though with this strategy, you'll never lose your shirt. You know, like there's never going to be that point where you're just like out thousands of dollars. So yeah, you could lose money. Usually the way it works is, let's say for example, with CCS, it doesn't reach $55 a share this month. So I sell another contract against it. And then what happens, let's say it dropped down to $45. Sell another contract at $45, maybe $50, and then it jumps the next month and it's like $55 or $60. I could very easily lose money at that point, because the far outside the money or far inside the money trade that I placed has lost some value due to theta decay or time decay.
Gotcha.
And so at that point, it's like, oh, I'm losing now. So yeah, you could lose money there.
Okay. So in a world where you're riding it pretty good right now, if it stays this course and February 19th rolls around, or close to February 19th, is your next move to buy to exit that sell and then put another month out for a similar price point?
It depends on where the stock's at. I mean, if it dropped back down in like the $45 or $40 range, where it's like it's really going down, I would probably try to get out, because I might again lose money, or I may try to roll both of these options out. So like take the June one to July or August if I can, and roll this one again into March or April. So that's one strategy. But however, if it's going up, like if it's at $40, $50 or even $53 or $54, then what I'll probably do is just roll that option, the February option, to like a March $60 option, if that makes sense.
Okay.
So a little bit farther outside the money, just kind of try to increment my way up month by month.
So are we trying to make our money off of the sell option, or are we trying to make our money virtually by trading stock with the bought call option? Where is our money really coming from mainly in this, in the poor man's?
Yeah, good question. The money's from the spread, essentially.
Okay.
And so,
the delta spread, what you mentioned earlier. You want something below 90, or sorry, greater than 90.
Above 90 and 40 or less. You want like a 50-cent spread there.
And that's where we're making, okay.
Yeah. And so then, and I think I did this with GRWG this month down here, where it quickly gained a lot, like it made 25, 50%. And so I just rolled both of those options farther up. And it allowed me to cash in a little bit of my winnings, but also allowed me to stay in the game a little bit more. But the price just kind of went up a little bit there.
Awesome. Yeah, no, that clears up a lot.
Yeah. And for those people who are watching the YouTube video, trying to maybe still wrap your head around this, I will also post some other channels that I used. It took me a while to learn this strategy. And so I'll be happy to send you some links kind of explaining some of this stuff to some other people. With options, it takes some time to understand, and one of the best ways to do it is just to trade an option. And it may be you may get involved with paper trading before you get involved in buying actually and using real money on this. But I would say the more you do it, the more you can be successful at it. Well, something I started doing just as a pet project back in December, as I wanted to see in this market how much, if I had, say, $100,000, how much I could make just by trading this strategy. Because really the goal is to generate income consistently on a monthly basis by trading the poor man's covered call. If we're just in it to take a risk and make a chunk of change, you wouldn't really use this strategy. This is a safer strategy to use to trade options. But I did start kind of tinkering around and say, what could I do if I had $100,000 just to use for the covered calls? And I'll show you, this is my paper trading account. In December, that started off, E-Trade offered me $100,000 of play money. And I just kind of treated it like I said, here's what I'm going to do. I'm going to trade it and pretend that every month I'm going to use $8,000 for my income and see what I can live off of. Well, as of today, this account balance is at $221,000 total. I've left $8,000 a month out, so I don't pretend like that money, or I pretend like that money doesn't exist. And it's been actually a really successful strategy. I've got these diagonal spreads you can see almost everywhere, besides a Pinterest spread that's vertical and a CCS spread that's vertical. Every other one of these trades is diagonal, and it's been really successful. You can see some of them not so much, but you can kind of see the net gain here as well. And I've been doing this for 3 months, and it's actually proven like I've earned over $100,000 by trading this strategy. And so it's a cool way, I think, that you could legit you could legit use this strategy long term to generate income along the way. And so if you've got a decent amount of money in your account, you could use this strategy and basically live off of what you bring in every month. And that's something that I'm trying to work to right now. Any other thoughts, questions, Zach?
No, I don't think so.
Cool. Well, again, for everybody watching at home, thank you guys so much for tuning in with us. If you have any questions, feel free to comment. Feel free to email us. I think my email address, I'll list my email address. I think it's ben@merrymentrading, or maybe it's merrymentrading@yahoo.com. So feel free to email us with any questions you may have, or comments, or any other strategies you think we should do a video on, and we'll be happy to cover those along the way. Until next time, have a fantastic day. God bless, and take care.